Welcome to the first issue of Monetary Commentary, where each month we explore the long arc of macroeconomic thinking, policy and money evolution and market structures. Our debut begins at the heart of 20th century monetary transformation, the rise of inflation-fighting central banking, born in pain, refined through recessions, and once again put to the test. In the history of monetary policy, there are few figures as defining as Paul Volcker. His name evokes a singular moment when the Federal Reserve, after years of economic drift and policy hesitation, made a decisive break with inflation. In October 1979, Volcker, newly installed as Fed chair, launched what would later be known as the Volcker shock, a sharp pivot toward monetary tightening that pushed interest rates to levels not seen before or since. At its peak, the federal funds rate reached nearly 20%. The cost was a deep recession, surging unemployment and political pressure from nearly every side. But the reward was the restoration of price stability, and with it, the re-establishment of central bank credibility. The 1980s disinflation stands as a turning point not just for the U.S. economy, but for the global macroeconomic order. It marked the start of a multi-decade era characterized by declining inflation, falling borrowing costs, and the belief in rules-based central banking. The legacy of that episode has informed every major monetary decision since. But it's only when inflation returned in the early 2020s, after more than a decade of price stability, that the ghost of Volcker reappeared in earnest. To understand where we are now, and where we might be heading, we must begin by comparing these two great inflationary moments. The one Volcker tamed in the early 1980s, and the one Powell faced after the COVID-19 pandemic. Both were driven by supply disruptions, both were amplified by demand, and both forced the Fed to make aggressive decisions under conditions of extreme uncertainty. But there are important differences, not just in the sources of inflation, but in the structure of the economy, the tools available to policymakers, and the global context in which monetary policy now operates. The inflation of the 1970s had deep structural roots. The US dollar's convertibility into gold had ended in 1971, leading to a more discretionary monetary regime. Oil shocks in 1973 and 1979 drove up energy prices, but the inflation was already embedded. Fiscal deficits from the Vietnam War and Great Society programs had run hot through the 1960s. Labor unions were powerful and widespread, and wage contracts often included automatic cost-of-living adjustments that linked future wage growth to past inflation. The economy had begun to internalize inflation as normal, if not inevitable. Attempts by the Fed to tighten policy were either too cautious or quickly reversed under political pressure. By the time Volcker arrived, inflation had persisted at double-digit levels for several years, peaking at over 14% in early 1980. Inflation expectations were unanchored. People believed prices would continue to rise, and behaved accordingly. Volcker's solution was to shift the focus from targeting rates to targeting the growth of the money supply. The change was more than technical. It was a signal to markets that the Fed would no longer accommodate inflation. The Fed allowed short-dated rates to fluctuate wildly. Rates shot up to nearly 20%. Businesses failed. Farmers protested. Homebuyers were priced out. The economy contracted deeply, twice. But eventually, inflation broke. By 1983, CPI inflation had fallen below 4%. The policy had worked, though not without immense social and economic pain. Fast forward to the early 2020s. The world faced a new kind of inflationary shock. When COVID hit in 2020, governments around the world responded with unprecedented fiscal and monetary stimulus. U.S. Congress passed multi-trillion-dollar aid packages. The Fed slashed rates to zero and resumed large-scale asset purchases. Global supply chains froze, then sputtered, then struggled to meet resurgent demand. By 2021, inflation pressures began to mount. First in durable goods, used cars, appliances, semiconductors, and then in energy, food and services. By mid-2022, U.S. inflation had surged to 9.1%, the highest since the early 1980s. But the structure of this inflation was different. Unlike in the 1970s, wage growth was relatively contained. Labor union density in the private sector had fallen below 7%. The economy was more open, more digitized, and more financially leveraged. Unlike in Volcker's day, the Fed now has a 2% inflation target and a decades-long track record of meeting it. But the Fed also found itself behind the curve. It had kept policy loose in 2021, assuming inflation was transitory. That delay proved costly. And that's just one of many instances of policy lags. When the Fed finally acted, it moved quickly. Between March 2022 and July 2023, the benchmark lending rate rose from near 0 to 5.5%. The pace of hikes was the fastest since Volcker's day. But remarkably, the economy did not collapse. Unemployment stayed low. Consumer spending remained resilient. A recession, long forecasted, never quite materialized. Inflation began to fall, though unevenly, quickly in goods, more slowly in services and housing. What explains the difference in outcomes? Part of the answer lies in expectations. In the early 1980s, inflation expectations were unmoored. People expected prices to keep rising and adjusted their behavior accordingly. In the 2020s, expectations remained better anchored, at least initially, thanks to the credibility earned over 40 years of inflation-fighting central banking. Another key difference is that today's economy is less wage-driven. In the 1970s and 80s, powerful unions could lock in inflation through cost-of-living adjustments. In today's service-heavy, gig-based economy, labor has less bargaining power. Wages have risen since the pandemic, but not fast enough to create a self-sustaining spiral. That said, today's economy presents new challenges that Volcker did not face. First is the issue of debt. In the early 1980s, both public and private debt levels were relatively modest. Today, the U.S. government debt-to-GDP ratio exceeds 120%. Households and corporations are also a lot more leveraged. That makes the economy far more sensitive to changes in rates. A 5% rate today may be more restrictive than a 10% rate was in 1981. Second is the role of global capital. In the early 1980s, capital markets were smaller and more segmented. Today, capital flows are massive, instantaneous, and global. U.S. rate hikes affect not just domestic borrowing costs, but exchange rates, commodity prices, and financial conditions worldwide. Volcker's hikes triggered a debt crisis in Latin America. Powell's hikes have already tightened conditions in emerging markets, strengthened the dollar, and exposed vulnerabilities in both public and private credit markets globally. Third is the fiscal backdrop. In 1980, the fiscal deficit was around 2.5% of GDP. Today, it's closer to 6 to 7%. The government is running structural deficits even in a growing economy, raising questions about fiscal dominance and the sustainability of debt in a higher-rate environment. Volcker had the benefit of fiscal policy that, while not contractionary, was not aggressively expansionary either. Powell does not. Then there is the issue of demographics and globalization. The 1980s saw a demographic boom, baby boomers entering the workforce en masse. It also saw the beginning of globalization, with trade liberalization and the emergence of China as a future manufacturing hub. Both forces were disinflationary. Today, those forces are fading. Aging populations are shrinking labor supply. Deglobalization, reshoring, and geopolitical fragmentation are driving up costs. Supply chains are no longer optimized for efficiency alone, but for resilience and national security. These trends suggest that the era of structurally low inflation may be over. The key takeaway from all of this is that while Volcker's legacy remains a touchstone, the world has changed in ways that complicate simple comparisons. The Fed under Powell is acting in a more complex, more fragile, and arguably more dangerous macro environment. And while the early signs of success are encouraging, declining inflation without a deep recession, it's not clear that the danger has passed. Inflation may yet prove more persistent than anticipated. Services inflation remains sticky. Housing costs have rebounded in some areas. Geopolitical risks, particularly in energy and commodities, could reintroduce supply shocks. If inflation settles above 2% and the Fed accepts that as a new normal, The credibility it earned since Volcker may erode. If it tightens too much, it risks triggering financial instability in over-leveraged sectors. The balance is delicate, and the path forward is uncertain. What is certain is that the long era of easy money, of near-zero rates and QE, is over. That shift has implications far beyond inflation targeting. Asset prices, investment decisions, housing affordability, inequality, all were shaped by the low-rate regime. As we move into a world of positive real rates, many assumptions about valuation, leverage, and policy may need to be rethought. Volcker's legacy is not just about ending inflation. It is about restoring credibility. About doing the hard, unpopular thing when no better option remains. It is about the long term over the short term. Whether Powell's Fed has the same resolve will not be tested in the first hikes, but in how it responds when inflation plateaus at 3% and the political cost of further tightening grows. That is the real test of institutional will. In a 2005 interview, Paul Volcker said, "The hard part is not knowing what to do, it's having the will to do it." That remains true. Monetary policy is not just a science. It is also a political act, one that affects jobs, growth, inequality, and confidence. The ghost of Volcker is not a blueprint, but a challenge. It asks today's central bankers whether they are prepared to make the same trade-offs, bear the same criticism, and defend the same principle that without price stability, nothing else in the economy works. But beneath this regime shift lies a deeper uncertainty, the future of monetary dominance itself. The post-Volcker era was defined by a central bank-centric world, where monetary policy acted as the primary macro lever and markets took their cues from rate paths and inflation targets. But that balance may be unraveling. Fiscal authorities have become more active, more ideological, and more willing to use balance sheets to pursue distributive goals, whether industrial policy, energy transition, or defense spending. Monetary policy, once dominant, may be increasingly reactive, tethered to the inertia of fiscal ambition. If the 2010s were marked by monetary overreach amid fiscal hesitation, the 2020s may flip the script. This inversion is especially problematic in a world where central banks remain the marginal liquidity provider of last resort. Should deficits persist in the 6% to 7% range, and should Treasury issuance continue to balloon absent strong foreign uptake, the Fed will face escalating tension between its inflation mandate and its implicit role in maintaining Treasury market functioning. Quantitative tightening may prove unsustainable not because of inflation, but because of market structure, a shortage not of reserves, but of reliable buyers of duration. Meanwhile, geopolitical fragmentation is accelerating the breakdown of the deflationary architecture that defined the previous era. The global production web, designed for efficiency, scale, and price compression, is being unraveled by industrial policy, export controls, and escalating strategic rivalry. Supply chains are reorienting not for marginal cost, but for geopolitical redundancy. That doesn't just introduce friction, it embeds price instability into the baseline. Inflation, once understood as cyclical noise, is becoming structural risk. And yet the Fed still operates with a symmetric inflation target that may no longer reflect political or economic reality. Persistently hitting 2% may require levels of financial tightening that destabilize core funding markets, suppress productive investment, or spark political backlash. But allowing inflation to drift structurally above target risks eroding the credibility that underpins the dollar's global role. This is the new frontier of monetary policy, no longer just a trade-off between inflation and growth, but between credibility and functionality. The Volcker episode taught that price stability is the bedrock of a functioning economy. But Powell's Fed may soon face a harder question. What happens when the tools needed to restore that stability begin to undermine the system they were designed to protect?